All right, let's just jump right in. What if I told you that BlackRock, the world's largest asset manager, is staring down a complete 100% loss on a loan they said was worth full price just a few weeks ago? And what if that single loss wasn't just some isolated mistake, but maybe the first real tremor of a crisis that could shape the entire $1.7 trillion private credit market, a market that, by the way, holds a lot of people's retirement money? Okay, we've got to dive into this because this story, well, it pulls back the curtain on a massive, hidden risk right at the heart of our financial system.
So that's really the central question here, isn't it? How does an investment that's supposed to be bulletproof just vanish? In the world of high finance, a total out-of-the-blue loss from a giant like BlackRock is a massive red flag. We're not talking about a small miscalculation here. This was a complete evaporation of capital. A sudden, brutal zeroing out of an investment that, on paper, looked perfectly solid.
Okay, so this whole thing starts with a private loan, around $150 million. Now, look, for a company like BlackRock that manages $10 trillion, $150 million might seem like a drop in the bucket. But the real story isn't the size of the loan, it's the way it disappeared, the timing of it, and what that tells us about the foundations of this whole private credit market. I mean, as recently as the end of last quarter, BlackRock was telling everyone this loan was pristine, worth 100 cents on the dollar. And then, just a few weeks later, the valuation just craters, from 100 cents on the dollar all the way to zero. There was no slow decline, no chance to sell it off for parts, no deal to be made. It was a complete, total wipeout. That $150 million, just gone. And that kind of whiplash, believe me, it spooks the entire market. So who was on the other side of this deal? The company at the heart of this mess is called Renovo Home Partners. They were a home improvement company, basically a roll-up, meaning they bought up a bunch of smaller, local remodeling businesses. So as you can imagine, their success was tied directly to how much people were spending and the health of the housing market. But here's the thing. Renovo didn't just miss a payment. It suddenly filed for Chapter 7 bankruptcy. And let's be clear, Chapter 7 isn't a do-over. It's liquidation. It's the company saying, we're done, sell everything for parts.
And this is where it gets really wild. Take a look at the details from Renovo's own bankruptcy filing. The disconnect is just staggering. The company listed its debts, its liabilities, at somewhere between $100 and $500 million. And to cover that mountain of debt, its total assets, under $50,000. I mean, that one detail just changes everything. This isn't just a bad investment anymore. It's a serious indictment of the whole lending process. You have to ask, how on earth does a company get hundreds of millions in loans when it has less than 50 grand in assets?
And here's the kicker. This wasn't just BlackRock's problem. Sure, they held most of the loan, but they weren't the only big name at the table. We're talking about Apollo Global Management, another absolute giant, and Oak Tree Capital Management, a firm that's literally famous for being experts in risky, distressed debt. The fact that all three of these titans were holding an asset that went to zero overnight at the same time, that tells you this wasn't just one person's bad call. It points to something much bigger, a systemic flaw, a shared blind spot in how this entire industry values its assets.
So, how does a $150 million loan basically operate like a ghost, completely undetected? Well, the truth is, the sudden collapse wasn't really sudden at all. It was the final act of a carefully constructed illusion, a game the industry calls extend and pretend. Let's pull back the curtain on how this little bit of financial magic works.
The main tool they use to pull this off is something called payment-in-kind financing, or PIK for short. It's one of the most controversial tricks in the book. And this part is absolutely crucial. Public info shows that the lenders knew Renovo was in deep trouble for months. They'd already tried to restructure the loan, turning some of the debt into company shares, which is basically admitting the original loan was in bad shape. And part of that restructuring, they turned on the PIK financing. That's the smoke and mirrors tool that let them keep pretending everything was fine.
So how does this shadow default actually work? Well, it's pretty simple and kind of crazy. First, the borrower, in this case Renovo, doesn't have the cash to pay the interest it owes. Normally, that's a default, game over. But instead, the lender, BlackRock, says, hey, no problem, we'll lend you the money for the payment. Of course, no real money changes hands. They just add the interest payment onto the total loan amount. So the loan gets bigger, and here's the key part, they can still mark the loan as performing on their books. The manager gets to avoid taking a loss, and they keep collecting their management fees. In fact, since the loan is now bigger, their fees might even go up. It's a win-win until it all blows up.
Okay, so the Renovo collapse, it really gets to the heart of the biggest vulnerability in this whole private credit market. It's this massive disconnect between how these loans are valued on paper and the actual, real-world health of the companies that owe the money. This isn't just about one bad company or one sneaky financial trick. It's about the entire system.
And this really shows you the two different universes we're talking about here. Think about public markets, like the stock market. The value of a stock is set every single second, out in the open for everyone to see. It's transparent. If a company's in trouble, the stock price tells you immediately. But in private credit, there's no ticker. The value of one of these loans is decided by the lender themselves. It's called marking your own book. It's like grading your own homework. And these are the numbers that BlackRock reports to its investors. What the Renovo case proves is that these marks can be pure fantasy, reflecting what the lender wants them to be, not what they actually are, right up until the very last second.
And what makes all this even worse is the explosion of so-called covenant-lite loans. See, for years, loans had strict rules called covenants. Think of them like financial tripwires. If a company's health started to slip, it would trip a wire and the lender could step in. They were a crucial early warning system. But after the 2008 crisis, so much money flooded the market looking for returns that it became a borrower's market. And what's the first thing borrowers got rid of? All those protective covenants. So now, lenders are basically flying blind. They have no power to do anything until the company actually defaults. And by then, as we just saw with Renovo, it's way too late. All right, so now we have to zoom out and look at the bigger picture. This Renovo failure isn't happening in a vacuum. It's a symptom of a much larger issue. You see, the private credit market has absolutely exploded over the last decade, basically becoming a giant shadow banking system. So the billion-dollar question, well, the trillion-dollar question is, where is all this money coming from, and who is actually on the hook when things go bad?
The scale is just mind-boggling. $1.7 trillion. This market basically grew out of the ashes of the 2008 financial crisis. It took on all the risky corporate lending that the big, regulated banks couldn't or wouldn't do anymore. So this isn't some tiny, niche playground for billionaires. This is now a huge, systemically important part of our financial world. And the answer to who's exposed is pretty sobering. It's not just Wall Street. This risk is woven through the entire financial system. A huge piece of this pie comes from pension funds. We're talking about the retirement savings of teachers, firefighters, regular state employees. Their money is directly tied to loans just like the one to Renovo. It's also in insurance company portfolios, and more, it's being packaged into mutual funds and ETFs sold to everyday investors. Even the big banks are exposed because they lend money to these private credit funds. A problem here doesn't stay contained. And this creates maybe an even bigger danger, what's called the great liquidity mismatch. Think about it. All these investors, from pensioners to regular folks, are used to being able to get their money back pretty quickly. That's liquidity. But the problem is, the things their money is invested in, these private loans, are some of the least liquid assets on the planet. You can't just sell a loan to a mid-sized company the way you can sell a share of Apple stock. So what happens in a downturn when everyone wants their money back at once? The fund managers are trapped. It's a ticking time bomb.
Now, all these risks simmering inside the private credit market, they're getting cranked up to 11 by what's happening in the wider economy. The basic idea that justified these risky loans, that the economy would just grow forever, is turning out to be wrong. Renovo didn't fail because of some complex financial instrument. It failed because its business failed. High inflation and interest rates meant its customers just stopped spending. And trust me, it's not the only one. And you can already see the proof that a credit freeze is starting. Just look at the official data. The Federal Reserve's survey on bank lending is flashing bright red warning lights. What this shows is that banks are slamming the brakes on lending to businesses of all sizes. They see what happened to a giant like BlackRock, and they're getting very nervous about who the next Renovo might be on their own books. And that caution means they lend less money, not just to risky companies, but to healthy ones too. And that kicks off a really dangerous, self-reinforcing cycle. It all starts with us, the consumers. When we slow down our spending, businesses that stocked up on tons of inventory get stuck. They have to slash prices with huge discounts just to get some cash flow. That move crushes their profits, and just as importantly, it lowers the value of all that inventory that used as collateral for their loans. That leads to more defaults, which makes the banks and lenders tighten credit even more, and that just chokes the whole economy.
And again, the data backs this all up. Consumer sentiment surveys show confidence is falling off a cliff. At the same time, the volume of stuff we're importing into the country, the lifeblood of our consumer economy, is projected to slow way down. When people stop buying, the whole supply chain just grinds to a halt, from the ports to the trucks to the stores, and that's when layoffs start. The cycle just keeps feeding itself.
So, with all this evidence piling up, what's the official story from the industry leaders? Well, they're basically saying nothing to see here. They claim failures like Renovo are just issuer-specific, a one-off problem, not a sign of bigger trouble. But the data tells a completely different story. The reality is, demand is falling, cracks in the credit market are getting wider, and a whole bunch of companies, everything from car washes to auto lenders, are following the exact same pattern. They're marked as perfectly healthy one day and bankrupt the next.
And that really brings us to the bottom line. All these extend and pretend games, all the accounting tricks that have been propping up this $1.7 trillion market, they can't hide from one simple fact. The actual businesses behind the loans are starting to fail. As one analyst put it so perfectly, and this is a quote you really want to remember, leverage plus optimism is not a strategy, it is a countdown.
So, what are the big takeaways here? First, letting lenders mark their own book can hide massive risks, right up until it's too late. Second, tricks like extend and pretend don't fix anything, they just delay the pain and usually make it worse. Third, and this is the most important one, this is not just a Wall Street problem. This risk is connected directly to pension funds and regular investors. And finally, the era of super cheap, easy money that created this whole market, well, it's over. And we're just starting to see what happens next.
You know, the Renovo collapse wasn't really the first domino to fall. It was just the first one that was big enough and loud enough for people to actually hear it. And that leaves us with one final, really important question to think about. As the economy keeps turning, how many other performing loans are out there, hidden away in this giant opaque market, that are really just another countdown, waiting to hit zero?